Ready to elevate your credit understanding and score? With insider tips and a plan, you can take action to improving your score, which can save thousands in unnecessary finance charges. Let's tackle today's topic with your coach, Credit Kristi.
Hey friends, it's Kristi, your credit coach. Thank you so much for joining me for another episode. Today, I'd like to talk about the APR on credit cards. This is a very timely episode because last week, the Fed funds rate had increased 75 basis points. So what does this mean to you? First of all, the Federal Reserve is trying very hard to get inflation under control. A couple Fridays ago, from the time of this recording, the inflation numbers were presented and it has gone up to 8.6%, which is the highest it's been for about 40 years. Inflation affects how far your dollar goes. And in a really balanced economy, the Fed likes to see about 2 to 3% inflation. So 8.6% is very, very high. You're probably also experiencing much higher bills at the grocery store, obviously paying a lot more in gas. And keep an eye on your utility bills this summer because those are probably going to be higher than what they've been in the past. So let's get back to the Fed rate hike. This was the highest increase at one time since 1994. The Fed meets again in July, and there's a really good likelihood that they're going to increase it again then and also increase it again when they meet in September. So how does this affect you and why is it important? Most people don't understand what interest rates are tied to, so I just want to break that down really quick. The Fed funds rate hike is not affiliated with the interest rate on, say, a 30-year mortgage, although that has soared in the last few weeks and last few months. At the time of this recording, we are now well into the sixes. When we started at the beginning of 2022, we were still in the threes. There's this whole group of people who think that 6% is really, really high in the mortgage world, where it's actually quite average. Those interest rates were held artificially low for a long time, for a couple of years, for probably longer than what it should have been. So now it feels really yucky as high as it is, but it's also affecting this crazy housing market of ours. So between a 22% hike in values and interest rates being nearly double where they were only 6 or 7 months ago, housing affordability is virtually non-existent. I think of the last 25 loan applications that I took over the last couple of weeks, probably 20 of those were from people who are currently renting. They just heard from their property manager or their landlord, and they have a rate increase in their rental costs of somewhere between $400 and $800 a month. So now they start looking at maybe another place to rent and realizing good old American greed has taken over, and no matter where you go to rent, it's going to cost a lot more than it has just in our recent past. What's scary about that is we're all going to have less discretionary income or extra money to buy things and experiences, which means we're not going to be dining out as often, going to the movies, going to the store and spending money. And that's obviously going to take an effect on businesses. Smaller businesses may really suffer. Production of creating things might slow down if there's less demand for that purchase. And it's really obvious we are amidst a recession. However, it can't be official until that second quarter of GDP, which is gross domestic product, is announced 2 quarters in a row of the decline. So first quarter of 2022 was a negative 1.5. We're inside of quarter 2. And so when they make that announcement towards the end of July, just be prepared for them to state officially that it is a recession. A lot of times markets don't react to it until it's officially stated. So just anticipate that the stock market might react negatively, costs might go up, and people are going to feel some fear. The best thing you can do is have cash on hand and pay down that debt. So let's get into the real meat and potatoes of what I wanted to share with you today about the effects from this federal rate hike. So let's get back to it. The federal funds rate is basically the cost of money that banks charge to borrow money from other banks. It had been virtually 0% for the last few years, and we've had several rate hikes this year already. The chairman of the Fed had announced that we should anticipate somewhere between 6 and 8 rate hikes between this year and next year. So what they're doing is not a surprise. But if you look at the most recent rate hikes, it was like 0.25% or 50%, which is 25 basis points, 50 basis points, and this was 75 basis points. So in other words, 0.75% increase. So again, that's not what 30-year fixed rate mortgages are tied to. The 30-year mortgage rates are essentially tied to the 10-year treasury yield, and that is increasing as well. When the Fed increases their rate, almost in tandem, the prime index rate goes up. So what is the prime rate? The prime rate is set by the 10 largest banks in the country. So JP Morgan Chase, Wells Fargo, Bank of America, you get it. And basically all of their CEOs have to agree to an increase or a decrease in that interest rate. And the prime rate almost always falls in tandem with the federal funds rate. So as soon as the Fed announced their 75 basis points increase, the prime index rate also went up 75 basis points. So here's how it affects you. Most credit cards have a variable APR. So what does that mean? Variable means it can change, and your APR is basically your interest rate that you are paying if you retain a balance on that credit card. So it's the prime index rate plus some percentage. Let's say, for an example, 13.99%. And that's the spread or the amount of money that that credit card company makes if you carry a balance and pay that interest. Now, if you pay your balance in full before it's due, there's a really good likelihood your APR is 0% because you're not being charged interest. You're paying that balance off in full during your grace period. You essentially get a 25-day grace period throughout the month when you're using your credit card. But once that bill comes due, if there's a balance, you're paying interest on that balance. So there's a fixed APR and there's a variable APR. Really good chance that yours might be a variable. Also, there are different APRs depending on what you're using that credit card for. If you're just using it for standard purchases, it might be one APR. And if you do say a cash advance, it might be a higher, different APR. So there's only a couple of times that your APR might change. If you wind up making a late payment, that could increase your APR on your credit card. The other time an APR might go up on a credit card is when the prime index rate increases. Now, your credit card company has to send you something in writing, so that APR disclosure or that notification of your APR increasing has to be sent to you 45 days before your interest rate can increase. Now, part of that disclosure says you can opt out of a rate increase, but listen to my warning. If you receive this interest rate increase notice and you opt out of the increased or the new interest rate, here's what happens, and this is where it gets very dangerous. Your credit card company will close your account so you no longer have access to it, but you won't have to pay that higher interest rate. So they'll close your account, basically lock it in at the interest rate that you were at. You will no longer be able to access that credit card as far as putting new purchases or balances on it, and you'll have to pay that down. This is very, very dangerous because now you no longer have, let's say you had a $5,000 limit. Now if it's closed, you have a zero limit and you've got an outstanding balance against it. It will potentially destroy your debt utilization factor. So please do not opt out of that rate increase because they can and most likely will close your card and just require you to pay that remaining balance over time. And I just read in an article from thebalance.com that the average credit card interest rate as of last week is 20.65%. So you guys, the interest rate is going to increase at least 0.75% because the prime index rate just increased. That's going to bring the average up to nearly 21.5% APR that you're paying in interest on any balances that you carry. Here's where I get really nervous. That means the monthly payment is going to increase. That means more of your payment is going to go towards paying off interest before it goes to paying off your principal balance. And I just believe it's going to further prolong our ability to get out of credit card debt. So if you have a credit card balance that you carry forward month after month, this is where I really need to encourage you to go all in and do whatever it takes to get out of this debt before it continues to rise. I'm recording this podcast in June of 2022, and I know that Fed funds rate and also in tandem, that prime index rate is going to increase at least one more time, probably more realistically 2 more times this year. If that's the case, it could drive APRs much closer to, say, 25% as an average. So how do you get out of credit card debt? Take a look at your credit card statements. Usually, if it's a 2-page statement, the APR is listed on the second page. Mostly, they don't want you to cry all over your paperwork when you see it on the first page. So when you see your APR and you throw open your mouth a little bit, let's get our bearings together and figure out how to tackle this balance. I was talking to an amazing young lady last week who had 8 credit cards, and she didn't realize that the accumulated balances owed outstanding to the creditors was $24,400. And when I shared that with her, I could hear it in the silence that she just didn't know her balances collectively were that high. So I gave her a plan of attack. And here's what I'd like to say for you. If you've got some tiny little store credit cards, get rid of them first. Store credit cards are usually somewhere between 25 and almost 30% APR as it is. So pay those babies off in full. Keep an eye on your statement though, because I've seen a couple of the big designer department stores charge somewhere between $3 and $5 a month just to have their card if you don't have a balance on it. And if you didn't know it was there and you thought your balance was paid in full and you kind of put that paperwork aside, you could wind up with a late payment being reported in a month or two because they charge like the service fee. So keep a close eye on that. Next, when you get those down to zero, you're not going to close them up. You're just going to put those credit cards aside, take them out of your wallet, stay out of those stores, resist the temptation, and really focus on those next big balances. So if you have several bank issued credit cards, Discover Card, Capital One, Chase, those kinds of cards, and several of them have large balances, what I want you to do is look at the interest rate. So paying off those tiny little ones first and then taking that minimum monthly payment that you were putting to that and putting it onto the next credit cards is Dave Ramsey's snowball effect. But looking at the highest interest rate and tackling those credit cards with everything in you, that's called the avalanche method of paying off your credit card debt. So once those small little guys are gone, look at the interest rates that are on your larger bank issued credit cards and really spend the most of your attention on the ones that have the highest APR. If your credit scores are decent and in good standing, you might want to apply for one of those 0% transfers. Now they typically charge you 3% as a transfer fee of that balance. So you'll get a charge, let's say you have a $5,000 balance you're transferring over. 3% is going to be $150. But you guys, that's probably about 2 months worth of interest on a credit card that has about a 20% APR. So if you can get 18 months or 24 months of 0%, transfer that over, but don't get caught in the trap of now going back and using that other credit card that you transfer the money from. So we're not putting a temporary band-aid on this. We have to change our behaviors. Otherwise, you could wind up getting really buried in even more debt. So transfer that balance over to the 0%, and then with everything in you, tackle it. I'm saying look at things in your garage or your closet that you can sell. I'm saying pick up a side hustle or a job, help some friends out for a couple bucks. I've seen people be house sitters and dog sitters and spend their weekends off helping other people move and charging $30 or $40 an hour for manual labor. Pick up overtime where you can. And as you're paying off these smaller credit cards, take what you were putting towards those payments and slam it down on these larger credit cards. You guys, just for a while, just for a temporary moment in time, stop going out to eat, pack your lunches, make coffee at home. Instead of a happy hour, have girls' night in. Start to make some small, subtle changes that can save you $10 here and $20 there, and just keep reminding yourself that it's temporary. You're only doing this until you get out of this hole. I'm gonna be very honest with you. A couple of months ago, I saw a picture of myself on Facebook and I was like, wow, who's that chubby girl that, that's me. These last couple years have been very difficult on a whole lot of us. And I tell you what, I am walking around with 30-something pounds that don't belong on my body. And it wasn't until I saw a picture of myself that didn't bring me joy that I said, I don't want to live in that skin anymore. So instead of keep digging, I'm going to start crawling out. So I'm taking the right actions with what I put in my mouth and how I move my body to make the positive changes, because it's really having a negative effect on my self-worth and my confidence and how I show up in this world every day. And that's not worth it to me. I just read this report about the debt problem in America. And in this report, 45% of Americans say that debt makes them feel anxiety at least on a monthly basis. 35% feel guilty at least monthly as a result of the debt that they are carrying. And 1 in 5 report that debt makes them feel physically ill at least once a month. My friends, that is not worth it. Our health is not worth it. So I want to encourage you, make some big changes, not just temporary band-aids, big changes so that way you can get out of this debt, but more importantly, stay out of debt. I know for a fact that households that follow a budget spend 14% less Could you imagine having a 14% raise? That is essentially what you're giving your life if you follow a budget. I'm seeing too many people up to their eyeballs in 5, 8, 12 credit cards with balances, either close to maxed out and in some cases above the limit, above being maxed out. And if it is draining you physically, emotionally, it's taking a toll on your health, maybe your relationships, how you show up as a parent or as an employee or as a business owner, let's take charge of this today. I want to encourage you to start making those changes before this storm comes in and the costs increase, because there's too much on the line. Your mental and physical health is not worth it. I know it's not for me. And I sleep so much better when I don't carry credit card debt. But my friends, for years, it kept me up at night. So send me an email. Let me know about your journey. Let me know if this encouragement and this teaching helps you. Let me know if you have questions. Send me an email at questions@creditkristi.com. I'd love to hear from you. And I'd love to encourage you along on your way in your journey. Thank you so much for being here with me. And until next time, my friends, stay well.
Subscribe now and share with a friend to stay in the loop for new credit content and insider tips to maximize your credit knowledge. And follow Credit Kristi on Instagram.